You're on your roadmap to the latest in auto. Welcome to Highway Herald, where we explore the sharp turns of global events that impact both our highways and our wallets. In April 2025, Trump's tariff strategy roared back to life, igniting economic tensions that veered far beyond politics. China responded not just with tariffs, but with threats to unload U.S. Treasury bonds, shaking Wall Street and spooking Main Street. This isn't just a trade spat, it's a financial showdown. Let's break down the pressure points revving up this global economic standoff. Tariff tensions hit the red line. The real spark? April 2nd, when Trump amped up tariffs on Chinese imports to a blistering 125%, revving past the previous 104%. China responded fast and furiously with its own 84% countermeasure. But what really set off alarms was Trump's April 9th pivot, announcing a temporary 90-day tariff pause for most other U.S. trade partners, deliberately excluding China. That move didn't just feel like a slap. It felt like a steel-toed kick to Beijing's economic strategy. Beijing's answer? A full-throttle threat to dump its enormous stockpile of U.S. Treasury bonds, somewhere between $900 billion and $1.1 trillion. Not just a flex, but a full-on financial broadside. Chinese institutions reportedly started dialing back dollar purchases, with bond offloading already underway. Analysts dubbed it a trade atomic bomb, and that's no exaggeration. U.S. Treasury auctions saw immediate fallout. Institutional buyers hesitated, yields crept higher, and fiscal conservatives in Congress started sounding alarms. The markets picked up the scent of panic. And sure enough, China's maneuver started to spill into other sectors, dragging fears of financial contagion into the open. But China's actions weren't just about retaliation. They signaled a deeper shift in strategy. China's Treasury strategy: retaliation or reinvention. Now here's where the gears really start grinding. For years, China has used its massive U.S. Treasury holdings as both a financial shock absorber and a diplomatic pressure valve. But this time, Beijing appears ready to take a hit in the short term to set the pace for a long-term strategic overhaul. As of April, China's Treasury holdings have dropped to $759 billion, a sharp drop from their peak above $1 trillion. But this isn't just a fire sale. It's a calculated maneuver. Behind the scenes, Beijing is shifting its financial drivetrain, reducing its exposure to the dollar and steering banks toward more diversified non-dollar assets. Think of it as swapping out a V8 for a high-efficiency hybrid mid-race. Risky, but potentially game-changing if executed right. UBS and Deutsche Bank analysts agree, this isn't just reactionary, it's transformational. China is pushing the digital yuan into high gear, inking trade deals in local currencies, and redistributing reserves across multiple asset classes. The mission? Undermine dollar dominance and rewire global capital flow. And the impact is already screeching in. Bond markets are shaky, auctions are soft, and international investors are second-guessing. This isn't revenge, it's a precision strategy, running hot at the red line. Before we delve deeper, don't forget to hit that subscribe button. Your support fuels our passion at Highway Herald to bring you top-tier automotive and economic insights. Let's shift gears now and see how this strategy affects you and me. Collateral damage. Wall Street meets a rough road. And now, the ripple effect slams into the everyday driver. As talk of China dumping U.S. Treasuries grew louder, bond yields started rising, and Wall Street began to wobble. When yields go up, so do borrowing costs. That's not just an abstract number on a spreadsheet. That's real pain at the pump for American families trying to finance a home. China, it turns out, isn't just a major holder of U.S. government debt. It also holds a sizable chunk of U.S. mortgage-backed securities, over $1.32 trillion globally. And it's been quietly trimming that position, down nearly 20% year over year. With the spring home buying season in full swing, this couldn't come at a worse time. Mortgage rates are climbing, consumer confidence is sliding, and would-be homeowners are being priced out before they even warm up their engines. Making matters worse, the Federal Reserve is also shedding MBS from its balance sheet. That removes a major backstop, exposing the market to greater volatility. Analysts like Guy Sakala and Eric Hagan are already flagging widening spreads, declining appetite, and rising pricing instability. And it's not just America feeling the heat. Global markets are starting to feel the burn too. Chain reaction across global markets. The strain on U.S. financial markets isn't isolated. Global players are pumping the brakes. Japan, once a top-tier holder of U.S. Treasuries and mortgage-backed securities, is dialing back its involvement. Reports from Deutsche Bank and Bank of America Securities reveal that foreign participation in Treasury auctions has dropped from nearly 50% in 2019 to under 40% today, signaling a broader shift in confidence. This decline is creating turbulence, wider spreads, unstable auctions, and rising investor anxiety. The ripple effects are reaching Europe, with EU credit spreads widening and US bond futures being unwound. If investors start viewing US debt as politically volatile, capital could pivot toward Asia, where local currencies are strengthening and digital trade frameworks are gaining traction. To make matters worse, central banks, the once reliable safety net, are stepping aside. As the Fed cuts its balance sheet and foreign governments retreat, speculators and private investors are filling the gap. But they're far less stable, ready to exit at the first hint of risk. In this environment, even small disruptions can cascade, impacting everything from commodity prices to emerging market credit. And all of this is beginning to take a serious political toll in Washington. Tariff tensions fuel political blowback. Despite mounting market volatility and growing economic warning signs, Trump is holding the line, "We will win the trade war." But behind the bold rhetoric, the political guardrails are starting to wobble. Lawmakers who once championed the tariff strategy are now hitting the brakes, with several warning that the administration's approach could become economically self-destructive. Bond yields are climbing fast, the dollar is strengthening, and inflation is no longer a distant concern. It's knocking down the door. Financial analysts are now eyeing 2026 as a potential recession year, with risks spilling over from Wall Street to wrench-turners and shoppers on Main Street. Some insiders argued the administration underestimated China's grit and overestimated U.S. leverage. Rather than backpedaling, Beijing is doubling down, escalating MBS sales and stepping further away from dollar dependency. That forces Washington to consider a possible detour toward negotiation. Even Trump's 90-day tariff pause for non-China partners feels less like strategy and more like hesitation. With China showing no signs of swerving, this financial showdown is grinding toward a costlier, longer burn for U.S. households. So what does all of this mean for the road ahead? Let's wrap it up. Final lap? Slow burn? Or sudden blowout? So where do we stand? Is China just revving at the red light, or are we watching a calculated strategy unfold in real time? A sudden Treasury dump would hurt both nations, but a gradual strategic sell-off? That's the real threat. By quietly pushing yields higher and rattling investor confidence, China keeps the pressure on without triggering a financial explosion. Mortgage rates are climbing, and Treasury auctions are now high-stakes laps with no margin for error. What once looked like a display of American strength may be revealing structural weaknesses under the hood. This isn't just about tariffs. It's about control, credibility, and who's steering the global economy. If China plays this right, it could shift the balance of financial power for years to come. What's your take? Is China in this for the long haul? Could Trump's approach stall out? Are treasuries losing global trust? Is Main Street ready for impact? Can this trade war end without a crash? Drop your thoughts in the comments below. We'd love to hear your perspective. And don't forget to subscribe for more deep dives, breakdowns, and global auto and economic updates from your trusted pit crew here at Highway Herald. Thanks for riding with us. Until next time, stay sharp and keep your engine tuned. You can now check out any of the videos on the screen. There's more exciting content waiting for you.